Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Chantal, Marx, FNB Wealth Investments, Victor Seanie from Benguela Global Fund Managers. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV. Hashtag Stockwatch. Lady Gent, appreciate the time. Chantal, let's start with you. I'd frankly forgotten the date, but I had a look and my Naspers was down 80%. There's no panic here. This is just the 5-for-1 split. In essence, Naspers was flat on the morning.
Yes, it was actually up slightly because the share price was meant to go down by 80%. And the reason why it was meant to go down by 80% is that it's split in 5 parts. So if you take those 5 parts, the new share will only be priced at 20%. Or 1 in 5 of the old share price, but you are going to receive an additional 4 shares, and that will reflect in your broker account on Monday. So we did have a little bit of panic on the desk this morning as well, a lot of phone calls from clients, but this is just the timing of settlement, and you should have no difference to your financial exposure, except of course for the stock price movements that would have gone on anyway.
Yeah, it looks scary. It also has no effect. Chantal, let's stay with you a moment. Then, staying with Naspers, it's been one of the more regular picks on this show in recent months. We've got China. In fact, I was playing with the latest DeepSeek iteration earlier in the week. China tech is coming to the party, and of course, Naspers is still, a lot of it is Tencent. Your take on Naspers at current levels?
Yeah, I mean, so in terms of the China tech story, I think we will probably continue to see that momentum, at least in the near term. And I think it's particularly attractive from a share pricing perspective and a share rating perspective, just because there's so much fearfulness around the US market at current, and valuations there are quite stretched. So investors are trying to diversify their AI exposure, and Tencent fits into that quite nicely. I think the other reason to like Naspers is the fact that that process in essence is being managed very differently to what it was a year or two ago. A lot more active portfolio management taking place, and that in itself could also help narrow the discount that Naspers trades at relative to its underlying holdings, even if you look through the process bit.
Victor, your take on Naspers/process? I mean, there's some small nuances, but broadly the same. Do you like the investment thesis there?
Yeah, very much like the investment thesis, underpinned by Tencent. And Tencent is doing great work with regards to AI. We see that Tencent is now the owner of the highest number of AI patents among companies worldwide. So they're doing a lot of excellent research. We've seen them use AI in their advertising business to great effect. Personalizing the ads a lot better. We've also seen them use AI in their gaming business, in generating gaming content, as well as increasing the amount of time that users spend on their games. We've seen tremendous growth coming out of their games, and then also in the AI infrastructure provision part of their business, we've seen that gear up in their cloud business. So the outlook is still really good for Tencent. And we see that there's no competition really from the rest of the world. So Tencent's got a really big market to themselves. So it's still an attractive investment case. And we do like the fact that Naspers is now run more for profit.
Yeah, that's a great point, and it is. I mean, their use of AI is as you say, it's bleeding everywhere into the process now. Victor, staying with you, we had the Capitec results out this morning. I mean, a lot to like about it. 25 million customers, HEPS and dividends up around 25%. They make the point that they're getting more sort of higher income customers, which has never really been their target market. Victor, your sense on the results and the valuation, because the question with Capitec is seldom about the quality of results. It's around the valuation. Your thoughts on both?
I think if I touch on valuation first, We've seen over the past 9 years where almost 10 years now, Capitec's median PE ratio is now settled at that level about 25.8 times. If you look at the trailing 12 months EPS, Capitec is on a PE of about 26.1 times now. Okay, this was at least before the market opened this morning. So it is trading at fair value levels. Yes, Capitec does deserve a higher PE rating than the rest of the market. The ROE is now at 31%, and management's target for ROE is at 25%. So way more outstanding profitability as well as superior growth to the rest of the bank. So I think if I were to the PE ratio at which I would let go of Capitec is probably 2 standard deviations above its median of about 26. Above 30 would be really expensive. I think anything below 24 would be attractive for Capitec. So it's a really more of a buy on the dip type of stock. In terms of results, very impressive across its business. There were some one-offs which probably won't repeat. So this 20%, above 20% EPS growth, I don't see coming in years to come. If you look at its interest expense, they had a one-off benefit really, but that benefit might carry on. But given them restructuring their interest rates that they pay to their customers, it just speaks to Capitec's ability and the strength of its ecosystem to keep customers and in effect to reduce how much interest they pay them. And also the other once-off impact of bringing the insurance business onto their own license, no longer paying away 30% of the funeral business. But overall, a great result. The banking business looks very promising. I think profit after tax there was up more than 80%. And the business is still very small. It's less than 11 times the size of its personal banking business. So tremendous growth potential, as well as its Everfin business. It could be the next new bank out in East and in Latin America. So a lot of growth vectors still for Capitec to capitalize on.
Chantal, I can't believe you're a Capitec hater. What's your take on it? I mean, there was just every time I read a line, it just seemed to get better and better.
Yeah, absolutely. So, I mean, this is a high quality business and it offers you exceptional growth. And I think that perhaps there would have been those one-offs during the specific period, but they still have so many levers to pull. And I think the mindset of that management team is exceptionally growth focused. So I think between business banking, ancillary services, including insurance, and the fact that they are really pushing into home loans as well, I think really gives them a competitive edge and growth runway that may not have been there 1 or 2 years ago, where the main focus would have been accumulating main bank clients. So I still like the story. I agree it doesn't look cheap. Capitec never looks cheap though.
Yeah.
And one thing that I would also note is it being one of the few proper growth stocks in the South African space, we're starting to see a lot of interest in emerging market equities, and I think Capitec is going to flag very well for international investors if they're looking for a place to park their capital. So yeah, I mean, I'd buy the dips, but I also won't be against taking a position now, taking a smaller position, and then kind of looking at whether or not I can find a better opportunity. But if that opportunity doesn't come, you don't necessarily want to be not exposed to Capitec.
Yeah, and I like an ROE of 31. Foreign investors are going to go gaga for that. Chantal, let's stay with you. A brave question coming through. Time to short gold. Futures just before I left the studio, $3,915. I don't know how brave you are in it. Would you be shorting gold? Would you be even taking profits at this point?
Yeah, I would absolutely not be shorting gold at this point. I think that the reasons why gold is high and why it continues to climb remain intact. I would start thinking about taking a brave position and shorting gold if any one of those, or if some of those drivers start breaking down. So the first thing is obviously the obvious one, safe haven appeal. The world is in chaos. Gold is an insurance asset. The second story is geopolitically focused. Central banks are continuing to accumulate gold because they don't necessarily want exposure to US dollars or to any other asset or any other currency that could be locked up in the case of geopolitical chaos ramping up even further. And then the final reason is that institutional and retail investors are picking up on this gold insurance policy story, and I don't think the flows, particularly from retail investors, have really come through yet. So there's still that possible leg up. Would I take profit? I think just from a portfolio construction perspective, if you are moving into a position where gold as a percentage of your portfolio is getting close to the 10% mark, that's probably a little bit too high, and then I just skim off the top and kind of follow that strategy as gold moves higher.
Victor, your take. I mean, gold's had a spectacular year. There's a good story behind it all over the place. As Chantal says, a lot of retail investors were actually net outflows last year, according to World Gold Council. What's your take on gold at these very elevated levels?
Yeah, I think the adage, be fearful when others are greedy, will eventually come into play. Yes, I think it's halcyon days for gold. Almost every possible driver is in gold's favor, from declining real interest rates to dollar weakness boosting gold to a state of high uncertainty. It's almost unprecedented to have this combination of both economic uncertainty because of trade policy as well as uncertainty because of geopolitical factors, all at the same time. And then the safe haven aspect, and I think perhaps probably the most supportive and sustainable structural supporting factor is central bank buying because of diversifying from gold. That probably still has some way to go and to continue, given this prolonged change, quote unquote, change in world order from the US to China, that would still play out over a couple of years. So I think the rest of the factors, they could turn. If you have settlement in the geopolitical space, we know Trump is hard at work, both in Russia and in the Middle East. The dollar, it's really weak. I think there's a chance that could reverse.
Yeah.
And then given inflation expectations, central banks might pause their rate cuts. And therefore, gold could take a pause. But we know that gold is at its highest level in real terms, possibly all time. So when things look this positive, it's hard to see continue on much higher for a very long time. So I would conservatively cut back on gold exposure somewhat. I might not go underweight. Short is a bit of a bold stance. It's not easy to short.
Also true.
Might be a little easy, early to short.
Yeah, but I take your point, and certainly, I mean, it's had a spectacular 2 weeks. Never mind 2025. Chantal, let's come to you. I don't know how closely you follow it. A bunch of questions. Purple Group, I actually chatted about it yesterday as well. It's up about 150% for the year. It is a small stock. My sense is it's a stockbroker, and with markets, gold, commodities, everything else, crypto at highs, brokers make money, and hence Purple.
Yeah, so particularly when there's quite a bit of volatility and decent volume coming through the market, the Purple should do well. I also think that Purple has a very loyal retail investor following. So, and because the stock is so small and relatively illiquid, you can see quite big jumps in the share price when you have a little bit of volume behind it. So I think fundamentally, brokers it's a very volatile business. So I think it'll be kind of like a sweetener to your portfolio in good times and perhaps something you will absolutely hate during bad times. But certainly in terms of their competitive advantage in their broking business being easy equities, that I think is quite entrenched now. And they continue to do really exciting things in that space.
Yeah, and I should disclose, I mean, I am a holder of Purple, but to your point, it is volatile, and there does come a point to take the money and run. Victor, is it a stock you watch? I mean, I was going to say it's a small cap. It's frankly a micro cap. It's probably a couple of billion ZAR in value. Is it one that you have on your radar?
One I used to have a look at in the past, but I think they're really well positioned with retail investor. With the penetration of investing in stocks, crypto, and so on, increasing among retail investors, it's the best positioned. It's low cost. It offers what retail investors like, fractional share trading, offers them access to crypto. So it's really well placed. It's in an environment where brokerage businesses typically thrive, rising markets. We know the JSE's been up 31% or so year to date. Crypto in USD is up 25%. So everything is going for it. We also saw, and the stock really took off in April. Before that, 5 months, it was roughly flat. And then they announced results in April, outstanding results. I think earnings tripled. Growth in AUM was about 31%. And then the next day, the CEO's wife bought about 195,000 Rand in shares, signaling confidence in the business. So yeah, and then the stock just took over from that point, just took off up, I don't know, 2.5 times since then. So yeah, it's a point in time where you kind of, when you're getting towards the end of the cycle, it's typically when you let go of a cyclical stock. So it's not something I would get into at this moment.
Yeah, and it was completely going nowhere until, sort of trading around $1 for 6 months, and then April happened, and well, since then it's up 2.5-fold almost. Victor, let's stay with you. Question coming through. Surely local clothing retailers are looking cheap. What would be a preferred pick from the panel? Victor, do you like local retail in the clothing space? Do you have a preferred?
Yes, I do. Right now, clothing retailers are pretty much unloved. They had a really good 2024 in the wake of the elections, and they've come off significantly. There was a little bit of over-exuberance at that point in time. But I think there's upside tremendously among all of them. I would pick carefully. I would stick to the high-quality names, and I'll stick to the ones that are best positioned in a South African environment. I'd lean towards clothing companies that are value retailers, really low priced, accessible to South Africans, and also probably retailers that are best positioned against competitors such as the Sheins and the like. So the two counters I'd favor are Mr. Price and Pepkor, well positioned in that regard. I know Mr. Price is on P of about 14, reasonable dividend yield. And if you look at the four main retailers, that's Truworths and Foschini, pre-COVID versus today, the retailer that's been best able to grow with EPS over that period has been Pepkor. So I do like Pepkor's positioning. They're doing good things in the rest of their fashion portfolio and at home as well. So those would be my two names.
Yeah.
Pepkor
and Pepkor's got, I was going to say, the little flash business. It's not so little anymore. It's quite the giant. Chantal, for you, a clothing retailer, or is it a sector? And it's had, as Victor said, a great 2024, a horror 2025.
Yeah, I think it was unreasonably sold off from towards the end of last year, because if you look at momentum in sales, we had a little bit of a blip in June, but that can be explained away by the change in school holidays and a bunch of other things, exuberance in the same month last year after the GNU. So July, again, trading momentum looked quite good. If you go through SA retail sales numbers, clothing retailers are actually among the best performing from a category perspective. So I think that these companies are extremely undervalued at the moment, and it's a good opportunity to invest before others wake up to that fact. I also like Pepkor. I think the fintech strategy just gives it a little bit of an edge as well, discount and value exposure. I also like Mr. Price, high quality retailer in that space. And then I also think that TFG looks very interesting. It's very well diversified. The Bash platform, I think, is excellent. And yeah, I mean, it plays in a little bit of a different area of the market, but also gives you value and discount exposure via Jet.
Yeah, and that Bash is a good product. I mean, it really, really does work. Chantal, staying with you, a question coming through. Neil Froneman, Sibanye-Stillwater, last day was yesterday. He's currently retired, I suppose. I don't know, spending time with his money. It's an end of a deal-making era. That's what he was always very much known for. The question I got coming through was concerns around him, Sibanye without him. Is Sibanye at a point now where it doesn't need the deal maker, perhaps it needs the manager? Your sense on Sibanye post Neil Froneman's exit?
Yeah, what Sibanye really needs is higher PGM prices, and it seems as if that is something that is finally happening for them. Yeah, I mean, I think Neil Froneman was an exceptionally interesting character at the helm of Sibanye, and he really was not scared to put money behind what he thought would be the best pathway for that business. So essentially, Sibanye was spun out of Goldfields. It was the worst assets in the Goldfields stable. They managed to turn around those those assets. They did exceptionally well for a few years. And I think he recognized that the party was going to come to an end, not because of gold pricing, because now we've seen a recovery there, but just the nature of those mines. They were deep, high-cost mines to run. So they pivoted into PGMs, which I think at the time was a pretty good idea. And even when PGM prices are low, people hate that idea, but it's a good diversifier, and I think it pays off when PGM pricing is at a more reasonable level. And more recently, the shift into battery metals, which hasn't really fired yet, but I think it's intelligent to diversify that asset base. So I think that the deal making is probably the DNA of Sibanye now, and I think they'll probably continue. They'll focus on reducing their debt burden, I think, in the near term, and enjoying these high PGM and gold prices. But I don't think the deal making will. I'll be very surprised if the deals stop for Sibanye.
No, that's a fair point. It's probably rubbed off on others. Victor, before we go to some stock picks, Sibanye, for you, I mean, the gold assets are very, very marginal. The PGMs obviously need PGM prices to rally. They kind of started coming to the party mid-year. Your thoughts on Sibanye post Neil Froneman?
Yeah, I think with regards to Neil Froneman, I think his life's work from Aquarius Platinum to what he did at Sibanye, bringing in the old stories, mines like Lonmin, Aquarius, and so on, would be a really good case study in M&A for any serious student of business over time. A very colorful character. I think he will be missed. I think probably the best course for Sibanye going forward is to first settle its debt. It's in a good position now, given the high metal prices, and then probably be more conservative and disciplined with regards to capital allocation going forward. I do think there will be less aggressive and bold in M&A going forward, purely because of Neil Froneman's absence. And so the first thing I would probably do is to get rid of the gold assets, run the PGM assets, and probably bulk up with the future metals, the green metals. And yeah, that's probably how I'd run the portfolio going forward.
I take your point. And at gold at these prices, those marginal mines are, well, not so marginal, right? At 3,900 an ounce there. Let's go to some stock picks. Victor, you're going with Bidvest. And I got to say, the results came out. I thought the market was maybe overly harsh on the results, or maybe not quite understanding strategy of management there. Your thesis for Bidvest?
Yeah, I think it goes with what's been one of the themes in the market this year, that SA Inc. stocks have been among the weakest performers on the market this year. And so one of the most unloved is Bidvest. If I look at the Bidvest stock price relative to the stock market since it split from Bidcorp, Bidvest at the moment in that chart is trading at its lowest level since 2016. And if you look at other multiples, it's trading on a P of about 12 compared to its historic median of about 15. And in terms of dividend yield, it's trading on dividend yield just over 4 compared to what's typical for Bidvest, about a 3% level. So evaluation, it's really attractive. Looking at the business, we know Bidvest is well diversified.
Yeah.
It is a pretty resilient business, really good management with strong capital discipline. Unfortunately, it's exposed to the really weak South African environment. But it has opportunities to make acquisitions outside of South Africa in hygiene and facilities management. So over time, as they bolt on those acquisitions, we should see earnings shift gradually over to higher growth markets. So I like Bidvest prospects going forward, and it looks attractive.
It does, and that debt, which some are worried about, I think will melt away over the next 2, 3, 5 years. Chantal, you're going with Birkenstocks. Birkenstock. I don't know if it's plural or not.
It's plural if you've got 2 on, but the company itself is called Birkenstock, and a lot of investors or would-be investors will say, well, they sell sandals. I mean, what's so interesting about sandals? But Birkenstock in particular is almost like an anti-status symbol, and that in itself has made it a status symbol. Very much focused on function over form. Once you own and love a pair of Birkies, you wear it for 10 years, and you wouldn't want to wear another sandal battle again. And it's almost become like a bit of a fashion statement as well to wear Birkenstocks from a casual wear perspective. A lot of collabs also with the biggest fashion houses in Europe and the US. So it really isn't just a sandal. There's a lot of white space still for Birkenstock. So they're quite big in Europe and the US, but a lot of avenues for growth in terms of Asia, the Asia-Pacific market specifically, as well as the rest of the world. They only have 70 retail stores globally.
Wow.
So I think that there's still a lot of scope for growth there. Revenue over the last 3 years has grown by about 20% a year. It's expected to grow in the high teens over the next 3 or 4 years as well. They came out of private equity, which means the business was loaded with debt and return on investor capital was very low, but they're very cash generative. So paying that debt down very quickly, and I think we can see a really clear path to them having an ROIC or return on invested capital that way exceeds their cost of capital over the next 3 years.
I must tell you, my very fashion-conscious teenage niece told me that if I wore those, I wasn't allowed to buy her ice cream, which shows how much she disliked them. I know. But that's all for Stockwatch today. Thanks to our guests, Chantal, Marx, FNB Wealth Investments, going with Birkenstock, Victor Seanie from Benguela, Global Fund Managers with Bidvest. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.